Good morning. My name is Carl Dakin, and this is the Successful Funding Show. This show was intended to start about 10 minutes ago, but the life of mine in working with raising funding is more dynamic sometimes than we care to think about. And we got into a question that needed to be answered. So we're going to get going here. Anyway, this show is all about raising funding and is intended to help anyone, anywhere, anytime, anyhow, raise funding they need to move forward. And quite commonly, we're dealing with entrepreneurs and small businesses, both startups and growth, but also working with charities, community projects, and government programs on different things that help build wealth, help get money into the hands of innovators so that we can make the world better every day. So that's why we're here today. And with me, again, an often frequent guest on this show is Eric Hansen with Manaya. And Manaya is getting ready to launch some new services with regard to creation of secondary market systems. And that's what we're going to talk about today is secondary markets. So before introducing my guest, just to make some clarification for all of you who may not be into all the languaging of the capital markets. When an organization raises money, sells securities for the first time, it's called an original issue. The name makes sense. It's the first time this particular security has been sold. And if you think of it like, I'm going to sell this here pen, the first time it's sold, it becomes its own item. It becomes an asset. It becomes a something that will show up on a balance sheet. And then if the person who buys this wants to resell it, that is when it becomes a secondary sale because it's not the original issuance. It's the person, the investor who purchased this is now going to move it to someone else. And within the sale of securities by private organizations, this is a challenge for them because of the fact that there is no guaranteed market. There's no marketplace. There's no certainty that there's going to be a buyer out there. And even if a buyer could be found, the road to find the buyer is burdensome. It's difficult. It's limited to the same kinds of challenges in selling stock or securities for the first time. And as a consequence of that, an investor who's looking at a private company, thinking about buying their original issue, is asking themselves, it's in the back of their head, can I find a buyer for this? Can I exit my investment and cash out of my investment somewhere down the road? And without knowing a buyer and knowing when they can sell it or how they can sell it or any of these other things that may occur, then they're in a situation where they go, maybe I don't want to do that. Maybe this is too hard, too risky. The cost on the backside of getting out of the investment may be so high that I won't really make the kind of return that I was looking for. And so this is a big issue for any organization that's looking to raise money because they have to overcome any reluctance of an investor candidate to buy into their company and worry about whether or not they can get out of their investment. So that's why I'm happy to have Eric on the program this morning, happy to talk about secondary markets, and happy to talk about how Manaya is approaching this problem and coming up with a fairly sophisticated, elegant solution to the problem. So good morning, Eric. Happy to have you with me this morning.
Good morning, Carl.
So, Eric, for those who are new, who haven't watched this show, with the fervor and frequency of a sitcom, the could you tell everybody basically a little bit of your background, talk a little bit about Manaya and how it's come together and where it's looking to go forward?
Yeah, so my background was in computer information systems programming. I'm one of the original COBOL programmers, and therefore original database programmers, that kind of thing, which led into all kinds of interesting parts of life. And recently, what we started out to do was crowdfunding. We built a crowdfunding platform, as you know, Carl, and crowdfunding had all kinds of problems. And one of the things that was a killer to crowdfunding was this lack of liquidity. So, and everything that we're going to talk about liquidity, it's true. It absolutely kills projects when you don't have liquidity. So after a couple of more years of juggling around the table, what we did is we said, hey, crypto is absolutely traded worldwide and is traded on thousands and thousands of exchanges. And so what if we could create something for small business that they in fact could use to raise money for their projects, then it be tied to a coin, not as a security coin, because that's a totally different animal, but as a utility coin that is a security. So we don't want to, what you definitely don't want to do is blindside the SEC and say your utility token is not a security. I think that's you're barking up something that is totally wrong. It absolutely is, but you don't want it to be a security token. And we can get into that maybe at another time because it gets a little complicated. But let's just say that we have a coin and we raise money for your business by selling the coin. And then after the proper holding period with the SEC, that coin is released into these thousands and thousands. I mean, our network alone is 22,000 different platforms. So we release that to our platforms, our associate platforms, allow them to trade the coin. Well, suddenly you have liquidity. That's the process.
Then again, because this audience is comprised of everything from sixth graders who are future geniuses in the business world to people older than me, and there are a few that are older than me, then the word liquidity is used to determine how easy, how quickly one can get out of an investment. And this varies because investments come in all shapes and flavors. So if I invested in gold, as an example, a very popular thing today, I would have to, one, have the gold in my possession or a gold certificate that is authentic and legitimate. And I still would have to probably go through a broker or intermediary in order to let people know that I'm trying to sell this gold. Now, I could go to my neighbor next door. I could just walk across the yard and say, hey, Joe, I'm selling my gold. Do you want to buy it? And Joe might say yes, and I might sell it the same day at current market rates. That would be high liquidity. What most people are familiar with is stocks that are traded on a public exchange, such as Wall Street, New York Exchange, and so forth. And on those, there's this huge existing system of brokers and traders and floors and exchanges and so forth, so that if I buy a stock, I can buy it in a couple minutes. And if I want to sell the stock, I can sell it in a couple minutes. And it may take a day or two for for the paperwork to catch up and formally close. But by all intents and purposes, I can convert stock to cash, cash to stock almost instantaneously. And that's considered to be the highest level of liquidity. And it gives the investor comfort that if any time for any reason they put money into a business in the form of an investment, they can get it out right away. So if I wanted to buy General Motors stock or Google stock or any of the current AI high flying stocks, I may think I'm going to get into it today, and tomorrow I can change my mind and I can get out. And that's cool and that's great. And as Eric was pointing out, one of the things that is appealing to people who have invested into cryptocurrency, which is its own story, and I'm not going to go off on my usual rant about don't invest in Bitcoin because that story is telling itself right now. But the thing is you can buy the coin, put it in your wallet, and then tomorrow you can convert that back to a different coin or back to a fiat currency, US dollar or um, euro or something else. And that ability to move back and forth is very, very attractive. And that means it's high liquidity. When you buy a stock from a private company, under most securities laws, you're required to hold it for a year. So your liquidity is already restricted by the regulations, which are intended to prevent people from buying and flipping securities in private businesses. But once you get beyond the 1 year, which calls a Rule 144 hold, then you're able to go sell it if you can find a buyer and you go through this whole thing. So let's say I have gold instead of stock. I go next door, Joe doesn't want to buy it. I can go walking around my entire neighborhood. Maybe I don't find a buyer. And then I go, well, since I can't sell it myself, I'm going to have to engage an intermediary who has the appropriate licenses. And I'm going to ask them to help resell this. And I have to give up a portion of the sales price to the broker as a commission for facilitating the sale, which eats into my return. And so now this is no different from selling stock on Wall Street stock because you're giving up commissions in between, and it's going to eat into your return on investment. But it gets harder and it takes more time, and the market is not quite as agile as you might like it to be. So it takes more time. Well, if you buy stock in a private company, say the coffee shop down the street, and you bought it through a regulation crowdfunding, there may not be anybody who wants to buy that stock. You may go to everybody in town. You might tell everybody you talk to. You might engage a broker, and at the end of the day, everybody goes, "No, no, that thing is not going to give me a rate of return that makes it attractive for me to buy it, or I don't like the manager, or any other reason." As a consequence of that, no one buys, and you're sitting stuck holding that investment. And if the investment is set up in the form of equity where there's a distribution of profits, there may not be enough profits coming back to you. There may not be any continuous flow of cash off of that. It's not like a loan where you get interest payments or interest and principal payments like in a mortgage. And it's not a revenue share where you're getting a piece of every dollar of sales that goes through the door. And so this becomes basically getting trapped into your investment, and liquidity then is the reason why people don't want to invest in private companies. They go, I can get in, but how do I get out? There are other ways for them to exit the investment, which requires structuring this into the operation of the business, which is not today's program. So we're not going to get into that. Eric, if you could explain a little bit more detail why coin will give some degree of liquidity where a stock certificate would not.
So in the coin world, you have multiple exchanges, and you have the ability to list your coin on these multiple exchanges. In the stock world, it used to be in the old days. Remember when they had the pink sheets and that kind of stuff? But it was very cumbersome. It was not what I would call a robust market at all, and it was difficult to find what you wanted. Today, in the coin world, you can go to almost any outfit, whether it's tZERO, CoinGecko, Coinbase, wherever, right? And you can go and look through what they have listed and instantly buy and instantly sell. So the coin world has developed this incredibly robust network through the blockchain that allows just all worldwide to instantly connect. And it has its own mechanism in the coin world of determining price. And it's very fast, it's very efficient. And in the coin world, they do some things that really aren't done much in the stock world. Okay, so one of them is in the coin world, they have a thing called liquidity pools. Stock world has the same thing, but it's very different. So in the coin world, if you have a specialty coin, let's just say that's it, and you want to guarantee, well, guarantee is a too strong of a word, but you want to make sure that the liquidity is there, then you can go and create a liquidity pool. And that liquidity pool, its entire focus is to make sure that that coin trades. And they're cheap. So, and you can fund the liquidity pool with coin, which is, this is novel, fiat currency, or surety bonds. So you have the ability to pick how you're going to finance the liquidity in case there is an illiquid event. That doesn't happen in the stock market, for instance, and certainly in the private placement market, that doesn't exist at all. There is no such thing as any of that. So the trick, isn't it, Carl, to take the private placement world and introduce it to the coin world, where the private placement world can change what they have into a coin, where we can take advantage of this massive marketplace.
Yeah, so let's talk about this liquidity pool, and again, we're going to jump back and forth between normal words and securities words. So the equivalent would be if we were to have something in the private world, and say I've got ABC Company, they've just sold 100,000 shares of their stock, and they received the money from this. To be the equivalent of a liquidity pool, they would take a portion of the money they raised, maybe 10, 20%, they'd put it into a reserve. And if any of the people who bought the stock from them should come back to them and go, hey, I need to get out of this. I had an accident, I've got a health issue, my kid needs to go to college. They would go into that reserve and they would agree to buy back that security at whatever price they determine. And because of that, there is a form of liquidity for the investor, but the company who's selling the security is going, yeah, but I just raised all this money. Now I have to take a portion of it. I have to lock it away to the side where I can't really use it to move my business forward. And I have to pay all the cost of raising the money and potentially even commissions on raising that money. And so the remainder of the money just got that much more expensive. So this is part of the reason, and plus it's complex. So if I'm a company, I just sold 100,000 shares of stock, and maybe at $5 a pop, I've raised $500,000. And if I have to take 100,000 and put it into an escrow account and hold it in reserve against any request by any person who bought my stock to buy it back from them in the future, that means I only have $400,000 left to work with. And that's not counting all the other expenses associated with this sale. And so that's not really attractive to people to do. And yet I have worked with people who have tried to make as many different exit points as possible. And that's part of my job as a capital coach, is to try to make this initial investment, the original issue, as attractive as possible. And so there are different ways of doing that. Creating a liquidity pool with the stock, though, is still hard, because if the company buys the stock back and then they cannot resell it, then they're stuck with their own stock. And at that point, all this is still not going where it wants to go, because even if this company sold 100,000 shares of their stock, that's just one piece of the overall capital market that is so small it's not even measurable. When you put it into a pool along with other people's stocks, now we're talking about a fund. So if you think of what Manaya is proposing to do, which is to create a cash flowing fund, then now you're investing in several companies at the same time. This is attractive to some people and less attractive to others. Putting money into a pool of additional companies is considered to be a risk hedge because you're saying, well, we may have some winners and losers. If you think of a venture capital fund, that will tell you out of every 10 businesses in which they invest, there may be one that becomes a high flyer that makes enough money to pay for a rate of return on investment in the fund, but they have 9 other companies. And the general rule of thumb is one's a high flyer if things work out. We have 2 or 3 that might make a little money. We'll have 2 or 3 that make no money, but we don't lose our money, and the rest all lose money. And the average of all these rates of return is the rate of return for the fund. And some people love funds and prefer funds, and other people want to basically throw the dice, put all their bets on a single horse, and watch it run across ahead of everybody else and get some great return in the future. So in that regard, what Manaya is proposing to do is create liquidity by making a availability of an exchange where you can sell this coin, thereby having liquidity. But at the same time, it's investing alongside of other businesses. Therefore, you're investing in a pool. So you're getting a number of advantages, but it's different from investing in a singular business.
Yeah, that's correct. That's what we're doing.
So we're doing. So this is very important now because if I'm helping a small business get ready to raise funding, I'm doing everything I can to get a rate of return within the investment itself. My approach is often to try to raise money from people who are stakeholders in the business, which are members of the supply chain, one way or another, or a local government that's benefiting from the economic development or a social cause, where there are a multitude of benefits to the investors. And I'm trying to find that investor who's going to get the most out of this particular investment. I still have to deal with the question of how does the investor exit the investment? And if there's no clear path to that, this becomes an automatic objection. And it's one of the greatest reasons why everybody doesn't just jump on investing in a private business. It's been one of the reasons why investment crowdfunding has continued to struggle to become everything it could potentially be. Because even though you only put in $100 as a non-accredited investor, a non-wealthy person, you still have $100 in the deal. And you're going, well, when and how do I get my money back? And if you don't have a good answer to that, that's in the pitch deck, that's in the offering document, there is no clear secondary market for this particular security, you'll probably walk away. You're going, I can do other things with my money. I can put it into crypto and I can sell it tomorrow. I can even buy fractional ownership in stocks traded on Wall Street and I can resell that. I can buy a lottery ticket, Powerball ticket, and I'll know within a few days if I won or I lost. And so it's all these different things you have to compete with when you're raising funding. In that the investor candidate has to look at all their other choices of what they can invest in. And if they find that your offer is less desirable than everything else that's on the table, then at that point, you're going to choose something else, and you're not that company is not going to be able to raise its money. So Eric, in a grand scheme of things, how do you see having the Manaya system implemented? What impact do you think it may have on the capital industry? What impact specifically may it have on investment crowdfunding offers?
So let's back up just a little bit, because you mentioned something about the illiquidity and the investor, and they buy and they sit on it and they get stuck with this asset. So what you did by getting them in to buy that asset, buy that little piece of security, is you took away that person's ability or the desire to ever invest again. Let's start with that. So what happens is the guy, you work your tail off, you create your crowd, you've got your crowd, you get them into the system, and you sold your security and you were successful. Well, as the crowdfunding platform, if this person can't get out or has a bad experience getting out, right, you now have to go create a whole new crowd for your next offering. So this is the difference in what Manaya is doing. So in Manaya's case, our crowd is all people who trade or all people who have purchased or want to purchase cryptocurrencies. That's our crowd. So it's a very, very big crowd. And this crowd is, quite frankly, they're quite sophisticated. So when we do an offering, right? Actually, we don't do the offering. When one of the companies does an offering, either through a 506 or some other Reg D or crowdfunding, right? Reg CF, when they sell their security for them and they raise money for them, they have created there's a coin, right, that's associated with that. And because there's a coin associated with that, and because we are our own platform, that means we can take that coin, put it in our platform, and we can have it available for trading after all the appropriate periods, right? But as soon as we've done that, we can then go out to other platforms, because we are one, and we can communicate to them and say, hey, guess what? We have this cool coin that we're trading. Do you want to be a part of it? And so you've increased exponentially the ability for something to happen, I guess is what I'm saying. And that in itself is pretty exciting, because there's no other, I don't know of any other method or way to get there unless you are big enough. And Carl, I don't even know what the restrictions are now, but to get on a minimal exchange, like let's say the NASDAQ. None of these small companies are ever going to get to the NASDAQ anytime soon. I don't even know what the requirements are, but it's huge. The requirements are massive.
Yeah, let's see, I was just trying to pull that up right now. The minimum requirement is you have to have a $4 million market cap and $2 million of tangible assets and $1 million of pre-tax income, which is something that a small business may want to pursue, meaning that you do it in steps. You do your first raise, which is your A round or whatever they call it these days. That brings in a little money. You make enough money. Maybe in your B, C, or D, or E round, you've gotten big enough that you can now apply to the NASDAQ, which has a lower bar to get into, and say, I'd like to sell my stock through NASDAQ as a publicly traded stock with all the cost and complexities and reporting requirements that go along with it. But you've reached that threshold, and that's where you want to go. So you're not going to get there out of the gate. The only thing that trades on NASDAQ as a startup company is something that's a spin-off or a SPAC or something else that is crafted to take advantage of an existing company that's already has all these assets and would ordinarily meet all the NASDAQ requirements. It's a private company of scale that's going public. So yeah, I see the ability to have a tradable token, you know, under whatever hold restriction exists, whether it's 1 year or potentially less. This makes all the difference to me. If I'm now talking to all my clients and looking at my own projects, which I am, I'm going like, why wouldn't I go through this process? And there will be some situations where maybe this is not the right fit for one reason or another. But there are probably a domination of reasons to go forward, because if I'm selling a security and I want to attract investors in, that's a tough job all by itself. And anything I can do to reduce that challenge is good for me or for my clients. But by investing in a pool, the investor has a chance to see an upside to that pool, as well as the liquidity issue. So this is one of the other things, and this is an important thing that Manaya is planning to do, is that they're looking for investments offerings where the business is going to cash flow to the coin holders. And to me, this is a very, very important thing. If I sell stock in a company and I tell a shareholder, new shareholder, you're going to get some profits someday, somehow, at some level, I don't know what that means as an investor candidate. I'm hopeful. I've read the offering memorandum. I've done my own maybe study of the marketplace, or maybe I've done nothing, which tends to be more common. And I go, okay, I think that this company is going to do well, and someday it's going to be acquired. When it's acquired, I'll get cashed out. Or someday, maybe they put a provision in there that in their second, third, or fourth offering, they're going to raise money and buy me out, or something like that. But there just aren't that many choices, and all of them are filled full of maybes. And this also goes for safe notes, which I'm also not a fan of, that yes, you can convert from a contractual obligation to an equity position sometime in the future if certain things happen. But there's really no provision for what if those things don't happen and you're stuck in limbo with a contractual right that is never triggered. So the conditions are never met. It's a little bit like a convertible note, which hopefully is a more rigid, time-structured thing that converts automatically from debt to equity. But you still then have the equity, and how are you going to sell it? What's going to get you out of the deal? And assuming that somebody's going to come along and buy the company down the road is falling into the fictional fantasy that every business is going to grow up to be a Google or Facebook, and obviously somebody's going to come along and buy the company out. The vast majority of businesses, 60, 70, 80%, will never be acquired, will never become a proper acquisition candidate, because they're simply not making enough money to justify it. And that doesn't mean the business is bad. It just means it's not investable. And therefore, they're going to struggle like everybody else to raise funding. So having liquidity, though, I think is going to have a profound impact on any of these markets. And this is true not just for investment crowdfunding or the individual business that's trying to raise money, but one of the things that I'm seeing now is that private equity companies who have already bought into a business, who've already acquired security in an existing business, they have the same challenge. They need to sell off that investment in order to roll the money back to their investors, the investors in their fund, and have money, hopefully, that the investors say, hey, roll that over one more time. One of the biggest problems in today's capital market is a lot of the private equity companies invested in things, including real estate, including commercial real estate, before interest rates went up and before the office market collapsed. And they're struggling on, what do I do with this asset? Nobody wants to buy it. They can't buy it and make money with it. And so they're stuck with an asset that they can't do anything with unless they sell it at a deep, deep discount, which creates a loss to them and that's passed along to their investors. So I see a lot of private equity companies may look at this system and go, here's a way that I may be able to trade my investment for CO2 coin of Manaya, and thereby, find a way to essentially liquidate my position in the investment as a private equity company, and give the coin. They could even pass the coin through directly to their investors as a distribution. They can say, "Hey, I've got this whole mall out here that we bought. Looked like a great deal at the time, and now it's not performing so well, and nobody seems to be in the market to buy it. I will exchange the mall for a CO2 coin." So that gets them out of the mall. The CO2 coin can be held, or it can be distributed to their investors in the PE firm. And now everybody is feeling better about themselves because assets have moved and some liquidity has been achieved. So I think right now, actually, one of the greatest markets for the Manaya CO2 coin will be private equity companies who need to get out of some of their investments in order to put money or coin back into the hands of their investors and move things forward. Do you agree, disagree with that, Eric?
No, I totally agree with that. And having had experience with company, in addition to that, there's many companies out there that, right or wrong, not going to get into it, but they have excessive debt for whatever reason. And other than the debt, they're actually a quite profitable company. So they're in a position here where without the debt, they make money, and they may even make good money. But with the debt, not only do they not make money, but they risk actually foreclosure, right? So the other aspect that you're talking about with the liquidity and these other things is the ability to trade the coin for debt. So that these companies can actually survive, because that's good for everybody, right? And the debt owners don't have to write it all off. And so you've got that aspect also. By using a coin, we have an instrument that's really interesting, right? We have an instrument that can be used for multiple purposes, and it can be purpose driven, if you will. So, yes, I think that there's this whole idea of liquidity it goes around multiple avenues, right? So, yes, we're talking about being able to have small companies get money where normally they couldn't, because nobody can see the value. You're having other companies that, we're talking to a hard money lender right now, and he has multiple companies that are barely marginally profitable because of the debt load. Well, he's going to have to foreclose on these companies. Eventually that's what has to happen. So when we went to him and we said, well, what would you do if you could take CO2 coin and get rid of 100% of the debt? And I said, it's going to be complicated. We get that. But what if you just theoretically, if we could trade the CO2 coin for you, get rid of the debt, and maybe you take a different equity position in the company now is pretty darn profitable. And the coin, you're going to be able to sell on the open market over a period of time. We're going to restrict you. We're not going to let you dump it all in one day. And the surprising result of that conversation, Carl, was there's a real interest because they don't want to, most people who do to lend money, they're not in the business to foreclose on companies because it's expensive.
This is one of the things that banks get ripped on all the time is they're going, well, if I don't pay off my loan, they'll just foreclose. And banks are in the business of lending money, not of foreclosing on money, even
That's
though
right.
that is their legal right to do so within the terms of the loan agreement. And there's all the cost attendant. They have the same issue. Well, if I loaned money on that car, how much can I get if I repossess the car and I have to use third parties to repossess it and sell it and pay commissions on it? The banks take that into consideration when they make the loan about how liquid the non-securities market is in cars, trucks, houses, everything that they lend money on. So all these things, are there. So the potential of having liquidity applies to a variety of different markets and applications, and from banks, liquidity, hard money lenders, private equity companies, and at the same time, from my perspective, since I'm focused on original issues, first raises of funding, I'm very, very interested in seeing how this plays out. So, due to other commitments today, we're going to have to call the show to an end. But this show is recorded on LinkedIn and YouTube. Anyone who has an opportunity to view the show today and has a question about the show and about what we're talking about today, I would invite you to send me an email. It's now displayed at the bottom of the screen, kdakin@dakincapital.com. And I'm interested in anyone who's interested in secondary markets and ways of creating liquidity within secondary markets. I'm even inviting regulators to call me and talk to me about, what is it we think we're doing and how we see this fits into the extraordinarily complex regulatory situation. Because this is a problem that needs to be solved. This is a problem that, if solved, this can make a world of difference to anyone who's trying to raise money into private businesses. And that's my business. So I'm here to help move the needle. Eric, thank you for being on the show today. I'll look forward to talking with you later about everything else that we were talking about before the show. But I've got a series of meetings that are going to take up the remainder of my morning. So maybe I'll touch base with you later this afternoon. Thank you, everyone,
Thanks,
for
Carl.
viewing the show today.